We start off with rates ripping higher, the 10-year yield up 60 basis points in just the last month. The move putting pressure on major averages, the Dow losing 4.5% in that period, the S&P 500 down nearly 3%, and the Nasdaq dropping almost 2%. But a closer look may suggest that even bigger problems are looming. Rate-sensitive sectors like home builders, regional banks, small caps plunging over the past month. So do these moves signal that cracks in the market could spread even further? Guy?
Well, happy anniversary. I wore a jacket for the occasion, which I never, ever do. But I'll say this. I mean, that is the story. And again, it wasn't the inversion in the yield curve. That's the warning sign. It's the re-steepening. And now in the 2s, 10s are as steep as we've seen in quite some time. But I don't think a lot of people anticipated 10-year yields a month and a half, 2 months after the Fed started cutting rates to be 4.7%. And I still think they're going higher. For whatever reason, the market is starting to care. I think it's going to care more the higher it goes.
And this is a global problem. It's not just in the U.S. that rates are rising. Japan is over 1%, for instance.
Japan, to me, is a lot more dramatic. I mean, let's talk about a 13-year chart in Japan on JGBs, the 10-year, which got up, and really have been crescendoing higher. In other words, I'm not even sure this is a level that we're going to rest at. And there is an argument that we've made that global rates are going to also partially pull up U.S. rates. There's been an argument about where Japan is. They have inflation. The question is, what are they going to admit to and what are they actually going to do? But, Japanese investors have been relative value buyers of treasuries. There's still a major discrepancy on that spread. Meanwhile, Chinese yields continue to go through the post-COVID lows. In other words, there's a real sense that the Chinese deflationary spiral is spreading. But everywhere else, there is pressure upward on rates.
Yeah. The Fed minutes were really interesting today. I thought Steve Leisman, when they first came out, had this assessment that 2/3 of what was in the minutes would have been the case for holding or raising rates. And
yes.
I thought it was very bearish as well for markets.
Well, that was interesting. And I think that presser, which was ultra hawkish, sort of reflected that. He said if you'd read these minutes and known what the outcome was, you wouldn't have thought those two things would go together. So that was sort of interesting, this idea that the Fed thinks about what if these policies happen and what do we need to do in front of that, where normally they just wait, see what are the policies, and then how do we respond. So all that having been said, though, I did cover a little TLT today just because I feel like it has moved so much. And then that auction was actually that actually wasn't anything to be afraid of, this one.
Yeah.
But I do think if things are going up for the right reason, there are some industries that can do well in this. Banks, for example, right? Rising rates could be a good thing for banks. Not so great if you don't earn a lot of money and it's all huge earnings, expectations in the future discounted back at a lower.
Tech.
Right.